Well, welcome everybody. Thank you so much for coming today. I am really excited to go through the highlights of the PPP reform, which I think of as relief for the relief, because the PPP was supposed to be financial relief in the first place, and it was plagued by so many problems that we ended up having to have relief for our relief program. But they did it, they passed it. And so first I want to start off with why we didn't think that this was going to happen. The House was much more generous and tends to be more generous than Senate with social programs. And so they wrote up this relief program, or relief for the relief, that nobody thought was ever going to make it past the Senate. I mean, it would just be impossible that the Senate would say yes to, you know, for example, extending this program to 24 weeks from 8 weeks, among many other provisions. And so even the AICPA at their weekly town hall said, look, we know it's going to change. We know some relief is going to pass, but there's no hope of this relief package passing, of what the House suggested actually coming all the way through to the Senate. But here's what happened. As you may be aware, the first day that people could potentially, be finishing up their 8-week forgiveness period was this past Monday. And they hadn't issued relief yet. They hadn't passed, Congress hadn't passed any relief yet. And so they were pretty concerned about the fact that if Senate said no to the relief plan as the House had written it, then they would have to send it back to the House, and there would have to be a reconciliation going on, so that the two, what the Senate said that they wanted, what the House said they wanted, would have to be reconciled together, and then that would have to pass. And given that this past Monday was the end of the 8-week period for some people, and as each day that goes on, we've got more and more people with their period ending and them not being able to actually benefit from any of this relief because they're not planning accordingly, right? They're spending the money according to the old rules. Senate just didn't feel like they could send it back to the House. And so, amazingly enough, shocking to all of us, they passed it as is, with one caveat. They wrote what is considered a letter of intent that is filed with it, so that as Treasury is interpreting it, they can look to the letter of intent by Senate and say, oh, this is what Congress meant when they decided to allow this, that, or the other provision from being passed. So it's not just one document, which is the bill itself, but it's actually two documents, because you have to read the letter of intent to get some of the meaning. And there's one very important piece of the puzzle that's being reported incorrectly because they're just reading the act itself and not reading the letter of intent. So make sure if you're looking at these as source documentation that you include that letter of intent with the flexibility, the PPP Flexibility Act itself. I've, as you may imagine, read a lot of analysis already from this thing that happened just last night, and done some of my own analysis, and I'm seeing there's a lot of misinformation out there. What the AICPA has released as their summary of this act is the most accurate thing I've seen so far. So instead of using my own list, I actually decided to hop on over and use their list because they've done a really good job with it. So I'm going to go through them one by one. I'm going to start off by saying, I know normally I encourage you to interrupt me with questions. You can still do that. Go ahead and just unmute yourself and ask away. But keep in mind, there's a lot that has not been addressed with this PPP Flexibility Act. There's a lot that we don't know yet. We are going to play the waiting game again for SBA and Treasury to come out probably on a Friday night at 8 p.m. like they always do, with guidance to explain some of the provisions that we don't understand and answer some of the questions that that we have. So when I'm done going through what we do know, I'm going to go through some things that we definitely don't know, and that may answer or not answer some of your questions. All right, let's get into it. So the biggest thing is that current borrowers have the option to extend the 8-week period to 24 weeks. And that's important. It's the option to extend. You do not have to extend it to 24 weeks. If you, as is, met all of the requirements for forgiveness under the old rules, that can still stand. You do not have to extend this to 24 weeks. But if you would like to, you can. Obviously, most people are going to pick that, that option, but it's not a required thing. So similarly, new borrowers, and remember, there is a lot of money left. People got afraid of taking these loans. They, said, "Ooh, I'm hearing all sorts of horror stories about forgiveness, and I'm hearing how administratively challenging it is, and I heard that they're going to be auditing people about whether they really have needs enough or not to support this." And so people got really afraid about taking the money. And at the same time, the accidental duplicate awarding of PPP funds, which happened to a lot of people, and the awarding of funds to companies that later returned it, that money is going back into this pot. And so the amount of money that is that has been claimed, some 500 billion as of this week, is the same amount as of last week, because the new loans aren't outpacing the amounts that are being returned. So it is not too late to apply. And now that we have this much more forgiving forgiveness, it's probably time to apply if you haven't already, or if you have clients who haven't applied, maybe it might be time to reach out for them, to them, or if you have friends that run small businesses, reach out to them, because now is the time to make it happen. So for new ones, for new borrowers, they are going to have a covered period of 24 weeks or December 31st, whichever is earlier, okay? And that is based on this congressional intent letter. That is not in the act itself, it's in the accompanying letter. So if you're a current borrower, you can extend it to 24 weeks. If you're a new borrower, you're gonna have 24 weeks or December 31st, whichever is earlier. The next one is this 75% thing. And this is kind of the aside from the 24 weeks, this is the biggest deal. It was gonna be that you had to spend 75% of the funds on payroll costs. And the other 25% could be spent on rent, mortgage interest, or utilities. And that has changed. It's now only 60%. However, with that change comes a really important thing that is so different. And I'm worried, I'm very concerned that people aren't going to pick up on this. People aren't going to realize that this makes a huge difference, which is it's now a cliff. It used to be that if you were under the 75% of payroll costs, you still could get partial forgiveness. And the way that worked is it looked at what your payroll costs actually were, and then you would divide it by 75%, and you would come up with the dollar amount that could be maximum potential forgiveness. That's not going to happen anymore with this 60%, which means that if you have spent 59.9% of these loan proceeds on payroll, you will not get any forgiveness, not a dime. Okay, this is really, really important. We need to make sure that we are reaching that 60%. And as a matter of fact, if we can reach the 75% that we originally were aiming for, all the better. You don't have to make that reach anymore, but if it's something that you can, be above 60%, so that if some of your payroll costs, it turns out the bank decides don't qualify after all, if they retroactively change any of the rules, you really want to be in a safe place. Now, this was not intended, and it is very likely that this will be fixed with a technical correction. But in the AICPA town hall that they said that they did today, they said, we can't count on technical corrections. And some of you on this call will know that we waited for that. We waited for the qualified business improvement technical correction until a global pandemic hit. Okay, so really long time, and we're having to do a lot of work to back our way into it. So I don't think it's safe to assume that we're going to have a technical correction. I think we should all just aim to get above 60%. Don't presume that that is going to be fixed later on with a technical correction. So the next one that I want to mention is there is an opportunity to avoid the FTA reduction penalties if the headcount is restored by December 31st instead of June 30th. So this was that safe harbor for people who weren't able to follow the FTE reduction rule, where you count your FTEs as of a comparison period, one of two, possibly three comparison periods you had to calculate, and then you calculate where you were for your forgiveness period. And if you don't make it to the lower of whatever your comparison period was, then we're going to have FTE, you'd have a reduction in the forgiveness amount based on your full-time equivalent FTE headcount. And then there was this safe harbor. If you didn't do that, but you hired everybody back by June 30th, then that was going to be your safe harbor. They've changed that date to December 31st, but they have not added any additional clarification as to how long you have to keep them employed. Does it just mean with the payroll that happens on December 31st, you know, that date is encompassed in, as long as that payroll has everybody back at their old FTEs, all of your jobs, not necessarily all of your same people, because it's a really long time away. And we still don't know the answer to that. We just know that the safe harbor FTE date has been moved to December 31st from June 30th. It's unclear if you meet the safe harbor date of June 30th, if that was your original plan and you meet that, and then you go back down December 31st, maybe you have a seasonal business or something like that, it is not yet clear whether you can elect to use the old safe harbor date or not. So that's one of the things we don't know that's out there. One of the things I think is really significant, not as much noise is being made about this one, because obviously the big changes with the 24 weeks and the 60% payroll requirements are the biggest things. But this one is actually pretty amazing. You know how there were these exceptions for FTE reduction if you tried to hire somebody back and they said no, they wouldn't come, and you would get it in writing, or if somebody had voluntarily reduced their hours or voluntarily quit, or you fired them for cause, and you would be able to add those FTEs back in. Well, they've actually expanded those things. They've expanded the exceptions to this reduction, this forgiveness reduction based on full-time equivalent employees. So if you are not able to rehire individuals who were employees, and this could be for any of the reasons that we just talked about, or you are unable to hire similarly qualified employees for unfilled positions. So this would be if somebody had really specific knowledge, like maybe I only have one person on my staff who knows how to do taxes, and you know, that person, hi Julie, and that person, you know, were let go, and I'm not able to find somebody to fulfill that particular role, that is going to be an exception as well. So specialized knowledge, specialized skills that you can't rehire for, that's going to be one of the exceptions here. And here is the really big one. I'm going to read these words exactly. If you are unable to return to the same level of business activity as before February 15th due to compliance with requirements established or guidance issued related to COVID-19. Okay, so that's pretty significant. If you are a restaurant, for example, that has to comply with state rules about capacity, and so you're not able to rehire people because you're not going to be able to reach that capacity, or you have state rules about how far apart your employees have to be one to the next, and you operate a bakery, for example, that is not able to socially distance in your kitchen, these would be things that you could actually get exceptions for. So to me, this is actually a really, really huge piece of the forgiveness puzzle. This is more like the safe harbor that we were hoping for initially when they released the safe harbor rules. So that's pretty significant. All right, the next one, the repayment period for the portion of the loan that is not forgiven, the repayment period has been extended to 5 years. It was 2 for new loans. Now, this isn't going to apply automatically to existing loans because you already have your paperwork that says, here's what your repayment period is going to be. But if you want to extend it, if you know that you're going to have forgiveness, not full forgiveness, and you're going to have a portion of it that is a loan, and you want to extend the loan period from 2 to 5 years, you can actually go back to your banker and say, hey, this new flexibility thing came out. Can we please agree on this? And they have every reason to allow that to happen. So you can go to them, and the interest rate's going to stay 1%. That part doesn't change. Here's another really big one. There is a payroll tax credit and a payroll tax deferral. These are other types of COVID-19 financial relief that came out in the CARES Act. You've got the employee retention tax credit, ERTC, and you've got the deferral of the employer portion of Social Security taxes. The ERTC is still mutually exclusive. You cannot take the ERTC and take the PPP at the same time. Those are not, you're not allowed to do that. And I'm actually seeing a lot of clients accidentally having requested that with, you know, if they're on Gusto or ADP or Paychex, those payroll companies made it a little bit too easy to opt into that. So I'm going through one by one and trying to reach out to those clients who did that to say, hey, you can't do that. We need to refund those credit dollars because it's mutually exclusive to the PPP. But the payroll deferral portion, now that it turns out was never meant to be mutually exclusive to the PPP. And so that technical correction was actually included in this PPP Flexibility Act. So now the way it's going to work is that if you want to do deferral on the employer portion of Social Security taxes, and to review for anybody who's not aware of how that's supposed to work, this would be deferring that portion until I'll tell you when. for people who didn't take the PPP, you can defer it for the rest of the year, and you would pay half of that deferral would be due by December 31st of next year, 2021, and the other half of it would be deferred to December 31st, 2022. So pretty good deal. You still have to pay it, but you're given a really long time to be able to pay it. So that now is going to be available for people who chose the PPP as well. But the one caveat is that you can only defer the taxes up until the forgiveness period for your PPP loan ends. Okay, so you can defer it up to that point, but your payback of this 6.2% of the employer portion of Social Security taxes, which are 6.2%, you can pay that according to the same rules that everybody else is going to follow. 50% due December 31st, 2021, and 50% due December 31st, 2022. So that's pretty fantastic. You are going to have to cut off the deferrals, however, when your PPP loan is forgiven. So that's great news. Wish we could do this retroactively, whatever. It is what it is. Loan payments. So for the portion that is not forgiven, that becomes a real loan, we just mentioned that that period can be extended to 5 years instead of 2. The loan payments themselves are going to be deferred. It was going to be 6 months after your disbursement date. But now it's actually going to be deferred until the SBA actually determines the amount of loan forgiveness and remits that to the lender. So you'll apply for forgiveness, which you have 10 months to do. We now have a time frame for that. You have 10 months to apply for forgiveness. And then your bank has got 60 days, and then SBA reviews it, sends it back to the bank and says, yes, you're forgiven. Your loan payments aren't going to start until that point. Or if you don't apply for forgiveness within 10 months after the last day of your covered period, then the payments will be required at that 10 months. So this is a huge, huge extension of time to make payments on that loan if you end up having any portion of the loan that remains. So those are the main 7 points. We've got the 24-week extension. We've got the reduction of the amount that has to be used for payroll is now 60% instead of 75%, but again, that's a cliff. We have all sorts of expanded FTE reduction penalty exceptions now. We have a new safe harbor date of December 31st for FTE reduction. We have the repayment period of the loan extended to 5 years for new loans. We have the payroll deferral access up until the end of our forgiveness period, and loan payments are deferred until your forgiveness is determined. Okay, so that's a lot of pretty amazing stuff. I'm going to talk briefly about what we don't know yet, which is, can you use the June 30th FTE reduction safe harbor instead of December 31st? As I mentioned earlier, we don't know. We have no idea if that's going to be allowable or not. We mentioned that the FTE safe harbor date is changing to December 31st. What about the salary and hourly wage reduction calculation? Does the safe harbor for that reduction change at all? Again, we don't know the answer to that. And my biggest question is, okay, our forgiveness period is being extended to 24 weeks. You remember that pesky rule that they introduced a few weeks ago about owners only being able to take 8/52 of their 2019 compensation as forgiveness? We do not know if that is going to be increased to 24/52 of 2019. You would think so, right? Because your period is now 24 weeks long, but we actually don't know. That would be really significant. We need to find that out, because that would be an amazing killer, fantastic, that would be just incredible, because we've got so many people who are Schedule C applicants and self-employed by nature of being a partner in a partnership, or people who have lower rent and utilities overhead, who are having trouble getting their entire loan forgiven. They made the calculation of the loan amount 2.5 times your average monthly, but they said you're limited by 8/52, not 2 months, not 2.5 months of your compensation from last year if you're an owner, which is not 75%, it's slightly less than that. So between that rule and the fact that some people have low overhead and some people have no employees, it's going to be really hard to get full forgiveness unless they come out and say, okay, now we're going to change this to be 24/52 of your 2019 compensation as opposed to 8/52. So that's a lot of stuff that we don't know yet, in addition to the hopeful technical correction that the 60% isn't a cliff, but is instead phased out. There's a question in chat about whether anything has changed for the EIDL loans. This is one of my big concerns, is that they have not yet come out and said unequivocally that the EIDL advance in all cases has to be subtracted from the PPP forgiveness. A lot of people are saying that. At this point, the majority of webinars that I'm attending and articles that I'm reading are saying, yes, it has to be subtracted. But there's a good 20% of folks out there saying, no, 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 no. Look at the legislation, look at the CARES Act. It says that as long as you are not spending that EIDL money on things that are eligible for PPP, as long as there's no double dipping. So for example, if you spend that EIDL advance on inventory, or I don't know, professional services such as an accountant or a bookkeeper, you know, supposedly initially that wasn't supposed to be an issue because there was no double dipping going on there. And now that is really, really unclear. AICPA specifically said this is still unclear. Treasury has not come out one way or the other. So I would hesitate as you're attending. I know all of us love, a lot of people on this call love Greg from Bookkeeping Made Easy, and he came out with an email today saying unequivocally, you have to subtract this, and I just disagree. I think we don't know one way or the other. I think we need to be aware that Treasury may decide that you have to subtract it regardless of what you have spent the EIDL advance on. We need to know that that's a possibility and we need to be prepared for it. But that's definitely not something that they've for sure said one way or the other, and AICPA made a point of mentioning that in today's town hall. As for the rest of the EIDL rules, nothing has changed. EIDL is EIDL. It's a working capital loan. You can use it for any sort of operations expense. You just can't use it to refinance other long-term liabilities. Any other questions? Feel free to put them in chat or just shout them out. Unmute yourself first.
I have questions.
Go for it.
So you said it wasn't clear if that June 30th would still be like a free-for-all about the full-time equivalent number.
Yeah.
But with the loan amount only equaling 2.5 months of what we pay out, how could we stretch the payment to those employees to keep them on all the way through December? It's almost
No, they're not saying all the way through December. No. Let me clarify that. What they're saying is that you could have 0 employees right now. You could have 0 employees from the day that you got, let's say I apply today for PPP, right? Or no, let's say I received my disbursement today for PPP. So today begins my 24-week forgiveness period. I could have 0 employees potentially. And now this is going to be a problem because you've got 3 different tests that you have to do. You've got the FTE test, and you've got the wage and salary reduction test, and then you also have the now 60% of the forgiveness amount has to be spent on payroll. But presuming you can pass each one of those tests independently, you can take for the FTE portion, you can say, okay, we had this many FTEs as of February 15th. Our FTE count went down after that. As long as we get it back up by December 31st, it was by June 30th. As long as we get it back up by that date to wherever it was as of February 15th, then you pass the safe harbor. So that's only if you're not otherwise hitting those FTE marks. This is a different way for you to pass that FTE reduction test. It does not mean I could have 0 employees right now, and then right before December 31st, hire everybody back to the levels at which they were at February 15th. And I would pass the safe harbor test for FTEs.
But that's just one test.
That's just
You
one
said
test.
There's 3 things.
There are 3 things. You've also got the wage and salary reduction test, and they have not told us if the safe harbor is going to change for that. That's one of the things we don't know. And then you've got the 60% of the forgiveness amount has to be spent on payroll, which of course right now is a cliff, which we hope changes.
And that would depend on if Jen and I as partners could take 24 or 50 seconds.
It would make all the difference in the world, wouldn't it?
Yeah.
Yeah. That's why we really need to know the answer to that.
Right on. Okay.
Yeah, absolutely. All right, another question that's coming in here. Let's see, what do we have? What about the $15,385 maximum forgiveness per employee? That has not changed yet. We have no idea. That's another one of the things, I should have put that on the list of things we don't know. We actually don't know if that is going to change yet. They have not made that clear. Obviously, what we're hoping is that we're going to have the same thing for each employee that Shirley and I were just saying we're hoping for the partners or the owners. Whether that's an S Corp, a C Corp, a co-op, a partnership, a sole proprietorship, Schedule C, gig worker. We've got this $15,385 cap. Of course, for the owners, we also have the 8 out of 52 weeks of the 2019. But we also have this $15,385 cap. We don't know if that's going to change either. They have not mentioned that. If a business got the EIDL advance, do they need to do anything if they don't want a loan? Yeah, you have to just not sign. When your bank reaches out with that information, you just say, no thanks, I'm not interested, and then you won't have a loan. You have to sign something in order to have a loan. So if you haven't signed it, you're safe. So would the state law prevents you from operating fully safe harbor eliminate the need to keep FTEs and wages and salary up to the described amounts? We don't think so. It looks like that rule is just for the FTEs, similar to the prior exception, because the way they phrased it is that they're basically expanding the FTE exception, I should say the FTE reduction exception, which was on the Schedule A worksheet. That was the one thing that you fill in, not the Schedule A itself, the Schedule A worksheet in the AICPA forgiveness calculator. That's the one thing that you would enter there for that exception, and they've expanded those exceptions. So I think that we're just looking at this where it applies to the FTE test. So far, they have said nothing about not one thing for the wage and salary reduction test has changed. That's the one thing, it was just not touched. That middle section, the payroll accumulator section of the AICPA spreadsheet, not touched at all. The rules for the FTE were touched, and the rules for the 75%, which is now 60% of the forgiveness amounts can be, need to be used for payroll costs. Those two were changed. So far, nothing about the wage and salary reduction. So following, what happens, I think I missed one here, let's see. So we've got, what happens in the following scenario? You get a PPP loan in early May, you bring your employees back and use the funds to keep them on until June 30th. Business declines for the rest of the year and FTE are lower by December 31st, and loan money was spent in May and June. Makes sense? Actually, it doesn't make sense, because none of this makes sense. I mean, they're changing the rules retroactively, right? So the rules don't make a lot of sense, but your question does make sense. In that situation, as long as you met your FTE requirements for the covered period, and you met the salary and wage reduction requirements, and you met the 60% of forgiveness being spent on payroll tests, you would still qualify. You just wouldn't want to use the safe harbor, right? You would want to use the FTEs over the period of your loan. And so if you have hit those FTEs in a period of 8 weeks, by all means, don't elect to use this new 24-week period. I have clients who are finishing up their 8 weeks now, and we spent all the money according to the old rules. We're probably not going to elect this 24-week period unless all of a sudden they say, actually, I can't imagine any situation where we would elect it if we've already spent it all correctly, unless we didn't get full forgiveness based on the way that we were handling it before. So remember that that's just that December 31st date to rehire everybody. That's just the safe harbor. You still have the original test that you can meet, and there will be plenty of people who can meet that test. Let's see. I think those are all the questions in chat right now. Does anybody else have questions? We've got 4.5 minutes left. I'm happy to talk your ears off about this. I recognize that it is one of those things that, you know, we're back in a holding pattern because we don't have guidance on a lot of this. But it's probably, I mean, my recommendation right now is for everybody to put the brakes on unless you already have a plan that works for you for getting maximum forgiveness based on the old rules.
I'm just trying to figure out if I can adjust my plan to pay my part-timers less weekly, but use this money longer.
Yeah.
But then they won't have the same equivalent hours, right?
Yeah, they won't have the same equivalent hours. So one of my concerns here, and the reason that for people for whom it works fine, is you know, you're talking about the FTEs over your covered period, right? And so if the FTEs over your covered period, and that covered period is only 8 weeks, and you're going to hit those goals, and it's not, you know, if that works fine for you because you're able to make the hours work, then, you know, that's good. Stick with that 8 weeks. In your situation, a recommendation that I might suggest, this is coming in actually on private chat from Bob, and I really appreciate this, is we'll probably want to put into effect the alternative measurements for FTEs, for the 0.5 and the 1 being all full-time employees and 0.5 being all part-time employees instead of using the real hours. You still have to divide by the number of weeks though. So Bob, I think that's a good idea, but this is still going to be, this is still going to be affected.
We're 5 weeks into our 8 weeks. So the amount of money we have left to try and drag it on, like, I don't know if that's going to make sense for us. It might be best, especially with everything else going on, to let our original plan lie as it was, to know that we get forgiveness. And then
if your original plan is working for you, then I don't see any reason to elect the 24-week period. However, if you are having challenges hitting maximum forgiveness using the original plan, I mean, the one benefit you would have is that 60% of that has to be used on payroll costs could give some people the opportunity to pay your employees less and use more of the money for rent and utilities. So that would be the one thing where I think you would get some benefit there.
But if you're paying your employees less, don't you not meet the FTE wage requirement?
Yeah, and we don't have guidance on that yet. So
okay.
We don't have guidance on that yet. I desperately wish I could answer that question.
I know
really
you would.
Yeah, I would in a heartbeat. Somebody said, have you heard of an S Corp owner that applied for PPP and simultaneously also applied using a 1099 MISC, so they got a combined amount? So in that situation, if you got a 1099 MISC as a Schedule C business and it's a separate business from the S Corp, that's no problem. You're allowed to apply per entity. So as long as that 1099 MISC was issued to the person as an individual and they filed a 2019 Schedule C for that, then that business does get the PPP and the S Corp itself would also get the PPP. So there shouldn't be any problem with that. If they accidentally got a 1099 MISC that it was for the S Corp, which they shouldn't have, but it happens sometimes, well then that would have been a mistake and they need to return that money. So we only have a few seconds left, so I just want to say, stay safe everybody. Please wear your masks and social distance and be kind. Take care.
Thanks, Nancy.
You're welcome.
Thank you.
Bye. Thank you.
Thank you.
You're welcome. Thank you for coming.
Thanks.